Welcome to the Shared Value Initiative 2020 Speaker Series, Resilience Reimagined. I'm Bobby Silton, Managing Director of the Shared Value Initiative, and I'll be your host today. For those of you who aren't familiar with the Shared Value Initiative, we're a global platform for leaders seeking business solutions to help address societal challenges. We're a part of FSG, a not-for-profit social impact consulting firm that was co-founded by Michael Porter of Harvard Business School and Mark Kramer. We're so happy all of you could be with us today. So a few housekeeping items before we begin. This session is being recorded and we are webcasting virtually from our homes. So we apologize in advance for any technical difficulties. Everyone in the audience has been put on mute and your camera has been disabled. We will have time for audience Q&A today, so please submit your questions using the Q&A function. And if you are on social media, please use these hashtags and handles as we would like to follow the conversation. Today is the fourth in a series where we're featuring purpose-driven leaders and hearing about their latest thinking. And over the course of the speaker series, we hope to explore what Resilience Reimagined means in a variety of settings and industries as a way to rebuild systems that are more adaptable, sustainable, and equitable. Before we get started with today's session, I'd like to mention a couple of upcoming events. So on October 1st, we'll have the CEO of Discovery Limited, Adrian Gore, in conversation with Dr. Lauren Smith of FSG, and they're going to be discussing disruptive leadership and responsive innovation. Then on October 7th, we're going to be talking about reshaping the path to an equitable economic mobility with Rebecca Marmont of Unilever and Shamina Singh of MasterCard. You can find details for both of these events and the rest of the Resilience Reimagined series at sharedvalue.org. So today we're here to talk about a new report that was published this past Tuesday called Hybrid Metrics: Connecting Shared Value to Shareholder Value. These days, investors are able to identify good companies and profitable companies, but not companies that are doing the most good, most profitably, which is a real missed opportunity for business, investors, and society. This research introduces a new concept of hybrid metrics that makes that connection more explicit. We're fortunate to have the lead author with us today, Mark Kramer, and he'll be in conversation with Leanna Orr of Institutional Investor. Institutional Investor also released this past Tuesday a companion article entitled Where ESG Ratings Fail, and you can find that article on their website. Before I introduce our speakers, I'd also like to just share a few acknowledgements. I'd like to acknowledge the FSG team and the Enel Foundation team who contributed to this research and report, as well as a group of expert advisors from the investment community that help provide perspective. We really appreciate everyone's contribution to this report. We'd also like to thank the Enel Foundation for generously funding this research, and to Susano and Yara International for additional support. We appreciate these organizations making these research findings available for use by the general public. Now on to our speakers. We have Mark Kramer today. He is the co-founder and a managing director at FSG, and also a senior lecturer at Harvard Business School, where he teaches creating shared value. We also have Leanna Orr, a deputy director at Institutional Investor, an award-winning financial journalist. She, in 2018, became a co-deputy of Institutional Investor, and these two women are the first to run the newsroom at Institutional Investor since the organization's founding more than 50 years ago. This is the second event that Leanna is doing for us this year, and we couldn't be more delighted to have her back in dialogue with Mark Kramer. So Leanna, I'm going to hand it over to you, and I'll be back to help close the session.
Thank you so much.
Yeah, I'm afraid you're on mute.
Thank you so much, Bobby. I appreciate the introduction and the opportunity to be back again with Mark and the Shared Value team. One thing that makes this piece of research and the Shared Values work really special and interesting to me as a reporter is that I feel like the combination of having the practical corporate insight from Enel, the academics view from the HBS lineage, combined with investors' perspective, means that for our audience at Institutional Investor, which are the people who run the world's largest pools of capital, makes it resonate for them in a way that either straight corporate or straight academic doesn't quite work. So thank you very, very much. Mark, I want to start by airing a complaint that you and I both know is all too common from both corporate directors and investors related to traditional ESG, which is there are too many rating systems, there's so many data sources, there are so many benchmarks, we don't know which one to follow. Tell me why the theory of hybrid metrics isn't just introducing one more set of standards.
Well, first of all, Leanna, thank you for being here, and it's been such a great partnership working with you. And I completely agree, of course. There are something like 125 different sustainability rating agencies. Studies have shown the correlation among them is only about 30% in how you do on one rating agency versus another. And there's just a vast amount of data. If you look at the GRI reporting initiative, it asks companies to report on every conceivable social and environmental impact that they might have. And of course, it's understandable because the origin of this sustainability metrics is really around holding companies accountable for their impact, and in theory, really for their negative impacts on the world. And so it makes sense that you ask them to report comprehensively on everything. And of course, different people have different views of what is a negative impact. For some, unionization, big anti-unionization is negative. For others, that's not an issue that they would take into account. So you end up with all these different rating systems, and none of them were intended to really help investors figure out which companies to invest in. And so when you get to that question, these systems really are not very helpful or informative because there are so many, because they are so contradictory, and because they're so idiosyncratic.
Mm-hmm. And so where does the theory of hybrid metrics differ?
So the idea of hybrid metrics is to say that within all of these different impacts that companies have, there are a very small number that are truly material to the financial success of the company. And so the first thing we need to do is focus in on those. And it doesn't mean that we shouldn't hold companies accountable for other impacts they might have. Of course, we need to hold them accountable. But from an investor perspective, we're interested only in those impacts that are truly material to the financial performance of the company. Recent research by my colleague at Harvard, George Serafim, in the last couple of years has demonstrated that when you look at just those material, social, and environmental impacts, you can actually distinguish companies whose stock will perform better than others. Those who are doing a better job of managing the material impacts perform 3 to 6% a year better over periods of time, looking at thousands of companies. So even there are an awful lot of material impacts, and the connection between the impact and the financial performance is still rather hazy. So hybrid metrics is trying to zero in even further to say, let's look at where there is a clear causal relationship. And so for Enel, the Italian power company, one of the sponsors of the study, they understand that there is a clear relationship between renewable energy and profitability. Renewable energy is actually more profitable for fossil fuel. It lowers than fossil fuel power plants. It lowers their cost of capital, and it reduces volatility. So we know there's a direct causal relationship between their shift to renewables and their financial performance. So hybrid metric says, let's create a new metric that is earnings relative to decarbonization. And we can actually compare different utilities to see who is decarbonizing most profitably over time. And so it actually uses the traditional financial measures of performance, pairs them with the relevant social or environmental impact, and enables you to create a simple number that you can then verify externally and compare across different companies within an industry on comparable terms.
It sounds very much like the old form of ratings.
Well, I think the old form of ratings does not.
Looking at it sounds much more in the language of an EBITDA than it does a.
Oh, yes, absolutely. And I think part of its strengths is it's using traditional financial measures and combining them with the social and environmental impact. And so particularly as we see more and more trading going to algorithm-driven trading and so on, I think you need to find a quantitative way of assessing impact that algorithms can actually handle. They don't do so well at digesting sustainability reports of 100 pages long.
Does anybody?
No, nobody does. That's another pet peeve, I have to admit.
In journalism, we have, there's a common theory of original sin that happened with the early shift to digital, which was that outlets began by putting their information for free online and then had to move the Overton window, claw back the expectation that content was free to actually have semi-sustainable business models. I wonder, I have a personal theory that perhaps there's likewise an original sin that comes with sustainability, shared value, ESG, which is that it began from a place of subjective do-gooderism or values. And so that's where the language developed. And that has led to a lot of investors still to this day feeling that those things are luxuries to worry about or for somebody else or a nice story, but ultimately, if related to financial returns, probably negatively related.
Sure, I think that history is absolutely accurate. And I think that mindset is still very present in a lot of the investment community that says, if you're taking into account social or environmental issues, it must be a matter of your own personal preferences, your own moral judgments, et cetera. And it isn't really seriously about finance.
It must be charity.
We simply think that's wrong. And if you go back to the work that my colleague, Professor Michael Porter, and I have done around creating shared value, the whole idea of that movement has been to say, really the greatest competitive opportunities, the greatest opportunities to make money are solving the world's problems today. And many, many companies miss this opportunity because they assume if you're doing something for a positive social impact, you can't be serious about making money. But we see that this was a huge omission in the work around corporate strategy. That in all of our thinking around corporate strategy, we ignored the external impacts that companies have. And it turns out those external impacts have very significant bottom line internal impacts that we simply had missed. And so if you think about Walmart, whose whole strategy is about lowest cost, until about 6 or 7 years ago, they had completely missed the costs of their environmental footprint, their use of energy, their trucking and transport and so on. By taking those costs into account, they've actually saved billions of dollars. And you can say, well, maybe the origin was a moral perspective about trying to make the world a better place, and that's true, but you can't deny the billions of dollars that they've brought to the bottom line by building environmental impact into their corporate strategy. And we think every company has an opportunity to build social and environmental impact into their strategy in a way that confers a greater competitive advantage and leads a path to greater profitability, which investors ought to be interested in.
So give us a few more examples of what these metrics are, what they might be, the material ones, the tie together the financial side,
Sure.
and the
And
impact side.
yes,
for a few
absolutely.
different
Alicia, maybe
companies.
you can share your screen and put up one slide. And I want to emphasize that this idea of hybrid metrics is really a germ of an idea. It is not yet vetted and well established. It's not yet clear that it will work across different industries and across different metrics. But we think it's a promising path to begin to go down. So as we think about it, I mentioned that for Enel, the ratio of earnings to carbon intensity, and for all utilities, is a material metric. In retail, as we think about working conditions in the supply chain, or as we think about the waste that comes from consumers disposing of packaging, fast fashion, and so on, there could be a ratio of cost of goods sold to the value of the waste avoided or to working conditions in the supply chain. When we think about healthcare companies and pharmaceuticals and medical device companies, you can think about earnings relative to health impact. And for example, you could use the daily adjusted life years, a metric that the Gates Foundation came up to measure their impact on improving health around the world. In terms of financial services, you can think about the financial well-being of your customers. This is something that PayPal pays a tremendous amount of attention to and has built into their strategy. And so you can think about your revenue relative to how well off your customers are. In pulp and paper, one of the participants in our study, Suzano, a company down in Latin America and one of the leading producers of pulp and paper, has a different way of developing their pulp than many other manufacturers. They use fast-growing eucalyptus trees, and it turns out the fast-growing eucalyptus trees absorb a tremendous amount of carbon from the air, much more so than mature forests. So you can actually look at the sales of pulp and paper and the carbon that is sequestered. Another participant in our study, Yara, the Norwegian fertilizer company, has all kinds of technical assistance they provide and special formulations of fertilizer to help smallholder farmers all over the world improve their yield and productivity. And as a result, Yara has a higher profit margin than others in the industry. And so again, we can look at profitability relative to the yield per hectare of the customers.
Fascinating. Are you ever afraid that there may not be a positive relationship between certain material factors and financial outcomes for companies? And how should corporations handle that?
Right. Well, I mean, first, I absolutely agree that there are many situations where there are negative impacts. And I think hybrid metrics can be useful there too. For example, if you want to look at the profit of an automobile company and the average mileage of the cars it sells, you might find that they're highly dependent on SUVs and other vehicles with very low mileage. And so they have much more risk in a low carbon world than you would see by just looking at the carbon in their manufacturing process. But I think that the reality is that we know a great deal more about environmental impact and social impact and health impact than we did 50 or 100 years ago. And yet most of our major companies are still operating on business models that they developed 50 or 100 years ago, when we didn't think about carbon emissions. We didn't think about the social determinants of health and so on. So I think those companies face a choice, and they can either try and bury their head in the sand and hold on to sustain their earnings for another quarter by trying to preserve their traditional model and ignore what we know today, or they can reinvent themselves and actually come up with a much better business model based on taking into account the social and environmental impacts that we know are so consequential today. And we see companies making both choices. But we think pretty clearly that the companies that choose a shared value strategy where they're really rethinking their business model to take into account what we know today are the companies that will be most successful in the future.
I'm sure that you saw perhaps a few weeks ago the CEO of a private prison corporation, publicly traded, complaining that the company and warning investors that the company had lost access to capital markets or borrowing money and had become extraordinarily expensive for them because of being unfairly judged by the ESG movement. Did that tell
Yes,
you anything?
and I don't have a lot of
about the
sympathy.
materiality factor? To me, it was quite an extreme example, but a powerful one.
I absolutely agree, and I don't have much,
on Twitter.
I don't have much sympathy for them. Yeah, and again, I think it's just an example of the recognition that social conditions, trends around social issues affect companies. And I think it is not just investors taking a moral stand, but investors also understanding that there is a growing awareness of the problems with our criminal justice system and a need for change there, which does indeed threaten the business model of private prison companies. So again, we've tended to put these things just in moral terms, and I don't want to discount in any way the importance of moral terms, but moral issues have financial consequences. And as the public attitudes shift, companies find themselves either benefiting or losing based on those changes, and they need to take these things into account in their strategy, and investors need to take these things into account in their investing.
The private sector has proven its mettle in some recent social justice fights. I'm thinking specifically of gay marriage, where Goldman Sachs, for example, threw its weight and conservative ethos behind that push. And then the current conversation and protests now around racial justice and social equity for Black people, particularly in America, has been, that conversation has been populated by the private sector as well. There's debate as to how much firms are doing versus tweeting. But where could hybrid metrics separate, be applied to a social issue like that?
Sure. We actually published a report a couple of years ago on the competitive advantage of racial equity by looking at the changing demographics of this country and the opportunities that companies are missing by not developing products and services that meet the needs of populations of color in this country, and by not adapting their hiring and training and advancement practices in a way that create opportunity that will fit with the workforce that will be the majority workforce very soon in this country. So even an issue like racial equity, which again is a paramount moral issue, also turns out to be a financial and strategy issue for companies. And I will say companies have played a very important role. I think about auto manufacturing plants that were among the first to integrate in the South, their workforce. There are many examples around gay marriage, about racial equity and so on, where companies have taken the lead and have benefited by taking the lead and had a positive social impact. But of course, there's a long way to go in this country at the moment.
And for this conversation, sorry, my internet is a little bit unstable.
I'm sorry.
Perfect, I am back now.
You are.
Moving back to the origin of this theory, to say, is sort of at its beginning stages of application. when did you and your co-researchers realize that shared value needed hybrid metrics?
Well, it really goes back to our work with Enel, and maybe we can put up the next slide, because what we found is that Enel was very well aware that in shifting to renewables, they were increasing their profitability. If you could advance to the next slide, thank you. But they weren't telling their investors that. You know, they were very proud of the shift to renewables in their sustainability report and their contribution to meeting the Sustainable Development Goals, and they talked a lot about it, but they never really thought to talk about it in their investor and analyst presentations. And again, this goes to the mindset that we see throughout companies around the world, that if you're doing something that has social and environmental consequences, you think about it in terms of your reputation, in terms of the NGO community, in terms of government, but you don't connect it to your investors. And so finally, last year, Enel, in one of their Capital Market Day presentations, began to talk about the economic benefit that came from their shift to renewables. And they found that in the weeks following that presentation, their stock price actually increased by 24%. It hit an all-time high because investors could begin to understand the connection between all this talk about decarbonization and the actual impact on Enel's bottom line. And so we began to think about, well, how can you communicate more effectively to investors this connection between what you're doing as a company that in terms of environmental impact and how that affects your bottom line. And so we said, well, let's look at a couple different European utility companies, competitors of Enel, and see what happens when you look at the ratio of EBITDA to carbon intensity. And what you find is that Engie is the company that is most rapidly decarbonizing, but they're losing money. They're not profitable. Iberdrola is decarbonizing quite rapidly and doing it quite profitably. And so when you look at their score, they come out way on top, and that's actually consistent with their score on many of the sustainability rankings that puts them as #1. When you look at Enel, they are decarbonizing not quite as fast, but they are doing it, again, profitably and more profitably than Engie. So this is a simple metric that enables you to look at one number across all players in an industry and begin to say who is decarbonizing most profitably. And presumably, those are the companies you'd want to invest in for the future.
And the concept of internal reward for corporations was, I felt, a really strong, almost psychological insight that you provided, you and your co-authors.
Sure. So, you know, if we're correct that what a company does around social and environmental impact on material issues affects their bottom line eventually, it will show up in their earnings eventually, and it will show up in their stock price eventually. But the problem is, without a more immediate indicator, it doesn't show up in the stock price. And of course, we know that the leaders of most major companies are compensated primarily in terms of stock and stock options. So if there is no reward in increasing the stock price by decarbonizing, for example, in the case of Enel, there's actually a rather strong disincentive for CEOs and boards of directors and other senior corporate leaders to be investing resources in decarbonization or whatever the relevant material, social, or environmental issue is. So we think that the real power of the hybrid metric, if it begins to be truly developed and adopted, is that companies can see the reward in a more immediate increase in their stock price from the longer term strategies that they're pursuing around positive social and environmental outcomes. And that should change corporate behavior. And I'll say there's one other dimension, which is there are no good internal tools for managers within companies to use when they're making investment or capital allocation decisions that enable them to not just look at the internal rate of return, but to also factor in the social and environmental impacts. And so we look at a company like Discovery out of South Africa, a life and health insurance company, that has done just an amazing job of developing incentives that actually lead their customers to have healthier behaviors. And that as a result, their customers actually have lower medical costs, longer life expectancy, and therefore Discovery is more profitable than other life and health insurance companies. And they have a formula they use internally that correlates the incentive and the cost of the incentive with the change in behavior, and the change in behavior with the change in health outcome, and the change in health outcome with the change in cost to the insurance company. And they can use this formula, which is beautifully combining both social outcomes and financial costs and outcomes to calculate what additional incentives they should be investing in. And this is the kind of equation that I can see other companies and other industries beginning to take into account.
What gets measured matters.
What gets measured matters, absolutely. And what affects your PE matters.
I feel like many of the participants on this call, particularly those who work on the corporate side, but perhaps as the head of sustainability, or specifically focused on the value, the non-financial value side, are totally aboard with these kind of initiatives and believe in the long-term financial value of pursuing them. And yet often it's a matter of winning over and making it relevant in the CFO and the CEO suite, which is something, as you say, that implementing hybrid metrics internally can have very, very powerful effect. When should these become part of a corporation's process and journey?
Well, you know, the first thing is I think it really does require differences internally in how corporations operate and how they are structured, frankly, because honestly, the sustainability officer and the chief financial officer and investor relations and the head of strategy are rarely in the room at the same time. Three of them might be, but sustainability typically isn't there. And unless you bring sustainability and investor relations and finance and strategy together internally in the company, you're not actually going to be able to report hybrid metrics, but more importantly, you're not going to be able to make the decisions as a company that enable you to perform better on the hybrid metrics. And so part of it is where sustainability fits in the corporation. And there's still an awful lot of companies out there that think this sustainability stuff is just about reputation. It's just about their brand and their image and whether they're getting picketed by NGOs and so on, and are completely missing the significance of these issues for their bottom line performance and their competitive position. And so we think that there needs to be a shift in how companies begin to factor sustainability into their strategy, their operations, and their financial reporting. And I'll tell you, you're absolutely right. There are a lot of CFOs and CEOs who, you know, yawn when they hear talk about sustainability and environmental impact and so on. But when Enel saw their stock price go up 24%, they said, you know, this seems to matter. This seems to matter.
No more yawning.
No more yawning.
And yet, Bobby has observed that even with corporations that she's been in contact with that seem to have fairly advanced or serious commitments on the sustainability side may not be using hard metrics or tying it to finances. So this is
again,
something that
I think there's
progress can be happening now. We're at the front edge. Is that accurate?
Oh, we're absolutely at the front edge. And again, it's a difference in mindset, because all of the sustainability measures that are out there were really developed about holding companies accountable for negative impact. Were developed by people who care a great deal about social and environmental impact, and in many cases don't care much at all about whether a company is making money or not. In fact, you know, a lot of them think companies like Pepsi or Coke should go out of business because they're creating products that aren't necessarily good for people. But what we're seeing is, again, a shift to begin to bring ever closer the social and financial metrics. And so, the hybrid metrics really grows out of a movement that has been happening for many years. The idea of integrated reporting has been around for about 10 years. Something like 78% of the 250 largest companies in the world now put some sustainability data in their annual report or financial reports. There's been a steady movement, but it's been very confusing because, again, there's so many different measures out there, and it's tended to revert to this rating system where each rating agency has its own definition of what's good and therefore comes up with different metrics from the others. And it's got to be simple. I mean, my colleague George Serafim at Harvard now is leading an initiative on impact-weighted accounts, which is actually trying to monetize the impact of products and company performance on social and environmental issues. But it's very complicated. I think that one of the great virtues of hybrid metrics, if indeed it pans out as people begin to explore it further, is the idea that it's really quite simple. We're putting a couple different numbers together and getting one number that helps us compare across an industry, and again, that can be externally verified by an accounting firm. And I think that kind of simplicity is essential if this is really going to be something that investors take into account.
Well, my personal favorite example of the subjectivity of the existing rating system on ESG, how Saudi Aramco outscores Costco according to MSCI. Costco being, to me, an absolute innovator in shared value, reducing packaging, having such a stable workforce. Because they take good care of people.
Absolutely, and that is, one of the strange dimensions is, again, because it's so much about thinking about companies' operations and their impacts. Many of these measures don't take into account the impact of the product or service the company produces. And so you can get great data about, the carbon footprint of a bank, but you can't really find out if they're making subprime loans that are pushing people into bankruptcy. And, Saudi Aramco can operate with all kinds of wonderful principles internally, but the fact is they're creating fossil fuel, and that's not a good thing for the planet. And so you really have to take into account not just the internal operations of the company and supply chain, but the impact of its products and services as well.
We've had about 5 questions from the audience on SASB. So one of the prevailing systems, which does explicitly try to identify materiality versus financial performance. Where does SASB fit into what you're talking about, and what do you think can be enhanced with the hybrid metric model?
Sure. Well, SASB is the giant on whose shoulders I've been trying to stand. I think the tremendous work they have done in something like 70 different industries at this point to identify what are the material, social, and environmental issues for that industry has been essential in cutting through the clutter. And they've done it by really engaging with leaders in the industry, not imposing sort of outside perspectives and views, but asking those in the industry what matters most to their performance. And when I say earlier that there's evidence that companies that focus their efforts on improving the most material social and environmental impacts, that definition of materiality comes entirely from SASB. So I think they have been absolutely an essential step forward, and the whole idea of hybrid metrics would not make much sense if we couldn't start with SASB's work around identifying materiality.
And would you say that would that be a good gold standard for investors who may be looking to calculate some of these themselves, or for corporations looking to identify which metrics they want to be tracking?
Yes, as I said, I think this is the germ of an idea. One thing that's important to emphasize is that hybrid metrics only work when there is actually a causal relationship between the social or environmental impact and the financial performance. So we do know with Enel that there is a causal relationship. There's a reason why renewable energy is more profitable for them than fossil fuel. And so that connection makes sense. So the first thing you have to do is be sure that you understand the causal relationship between the external impact and the financial performance of the company. And then you can begin to develop some metrics based on publicly available data and look across an industry. As I said at the outset, I think this is just the very germ of an idea. I think it will take a lot of experimentation on the part of investors and companies to really identify what hybrid metrics are the most meaningful in any given industry. And I know there's a certain reluctance on the part of companies to report any data that they aren't, required to report legally, and the risk of exposure to litigation if they make promises that aren't fulfilled. So I'm not naive in thinking that everybody's going to jump on this new metric immediately. But I do think that there's a way of thinking here, a kind of approach to this analysis that can be very powerful. And I'm hopeful that many companies and investors will try and apply this thinking and share what they're learning. And we can begin to really move toward some standardized measures within each industry that enable us to look across the industry at the performance of companies in a way that really combines both their financial and social environmental impact.
And on the reluctance to disclose side, I wonder if the ESG movement, which has been so heavily focused on disclosure, hasn't actually made a lot of progress there. That already, you cited the majority of S&P 500 companies, for example, are already disclosing data related to, say, sustainability or ESG. Now it's just a matter of tying that in.
It's a matter of tying that in and ensuring that the disclosures are being calculated in the same way.
Not just picking
each company is sort of making its own choices about what to disclose.
Right.
And again, because they see this as being often related to public relations, they tend to disclose what's good and not disclose what's bad, unless they absolutely have to. And so I think, and they do tend to define things differently, and there's some external verification, but not a whole lot yet. And we've seen examples with Volkswagen emission scandal and others that there are times companies simply falsify their data because they can get away with it. And certainly that's not a good thing to do. But I think that you're right. There's been a definite move toward more disclosure, and that does give us a starting point. But I also would caution that the existing disclosures do not necessarily have the verification and the consistency and the completeness to do the kind of calculations we want to do.
Those reports can often read like highlight reels.
Absolutely. And again, there's no incentive to disclose things other than for sort of public relations. But if we do begin to show a correlation with stock performance, then I think there will be a very strong incentive to disclose performance along these ideas of hybrid metrics.
And companies do not have the luxury of not disclosing bad financial outcomes. They can, try and backpedal and spin them all they want, but ultimately, general accounting principles apply, particularly if you're publicly traded. You can only offer so much adjusted EBITDA before you're no longer in compliance. Do you feel that there would for hybrid metrics to work, for companies to feel compelled to be reporting them, sticking to the same ones and reporting them year after year, is so that they are at an investor's fingertips? Is there a third party, something like a lead that rates green buildings, Energy Star, or something like the American Bar Association that will act as its own regulator? Does there need to be a third party, maybe it's the Shared Value Initiative, that's keeping track?
Yes, it's probably not the Shared Value Initiative, but
You're like, don't.
a third party would be very helpful. And it also gets around sort of the risk of litigation and some of the concerns companies have about inventing their own performance metric and then coming out and stating it publicly. It's a lot easier to have a third party do that for you. The only thing I'll say is, while some of this can be constructed from existing public data, much of it cannot be. On the Enel example, we talked about EBITDA relative to CO2. But the reality is that it's actually the gross margin on power generation that is more profitable. But that's not something that I can necessarily find in Enel's annual report. And the problem with using EBITDA is, of course, it's influenced by many other things, other cost-cutting strategies, acquisitions, divestitures, et cetera. And so with many of these companies, and actually if we want to put up the last slide for a minute, we looked at this in terms of the food and beverage industry as well. And we saw that when you look at the profit margin of companies, Campbell Soup, a fine company, comes out on top. But when you then adjust that by looking at the access to nutrition index, they don't do nearly so well. Now, the access to nutrition index is not a perfect measure of the health of the food products that are being sold, because it takes a number of different factors into account. Like other rating agencies, it is based on someone's view of what a good food company in the world should be doing on many different dimensions. So to really accurately get at the question of how profitable and healthy Campbell's food products are, we actually need some more detailed data about the salt, fat, and sugar content of the different food products. Again, things that may not yet be publicly disclosed. And so this is why I think it's important for companies to begin to play with this or work with investment banks to begin to play with these metrics, because I think to really get at that tight causal relationship, you need somewhat granular data, and that isn't always being disclosed today.
In some ways, I feel like you and your co-authors are doing the work that perhaps could be done by financial analysts.
Yeah, and I wish they would do it for me. That'd be great. I think that's true, but again, we've talked about this mindset, and I think it is still very much there in the analyst community, that social and environmental issues are kind of fluff, that they're not really about immediate or at least short-term, near-term financial performance, that they're not really material, they're about public relations, and that all these different ratings and reporting requirements and so on are just impossible to meaningfully deal with and compare consistently across companies. But I think that it also requires, to do this, it requires analysts to be quite knowledgeable about social and environmental issues and trends around the world. And that's not necessarily an area of expertise. We did do a little bit of analysis just with the companies we looked at, and found that those who were better at disclosing their shared value strategies actually had fewer earnings surprises. And so we do think that this disclosure is relevant to analyst estimates of earnings, even in the near term. But again, it requires analysts to think differently about how social and environmental issues matter. And that shift is a shift in perspective that is not easy to make happen.
And from the investor community that I speak to, which are primarily large institutional investors, ESG aside, I think that there has been growing dissatisfaction or perhaps disinterest in the analyst community. That a perception that particularly as institutions, what analysts care about and score and the horse race that they're interested in is quarter to quarter, which if you're $200 billion state teacher's investment fund or a sovereign wealth fund, you don't care.
Yep. Yeah, I absolutely agree. There's long been a mismatch between the analyst community and the asset owner, or between the investment advisor, frankly, investment manager, and the asset owner, because most asset owners do have a long-term perspective. And I know GMO, Grantham Mayo Van Otterloo investment firm, talks about the difference between career risk and financial risk. And as an analyst, when you get things wrong, there can, well, put it another way, when you get things right, but that's in the long term, and in the short term, things move the other way, you have severe career risk. You may not have financial risk because ultimately you may be right in the long term, but it's really hard to withstand the career risk of being wrong in the short term. And so I do think that there is a sort of structural problem in how we reward analysts and what we expect them to do relative to what is in the best interests of the asset owners for the long term.
Question from the audience, one that I am interested in because I have no idea what the answer will be. Saliency and materiality are not synonymous. How does saliency fit into hybrid metrics?
And I'm going to have to plead ignorance here because I'm not sure of what the difference is. So if you can enlighten me, Leanna, or whoever asked the question can put something into the chat, I'm happy to respond, but I confess I can't tackle that one.
As a graduate of English literature, I'm embarrassed to say, I thought they were synonymous.
And as a philosophy major, I'm with you. I'm with you there.
Another one from the audience. Do you see hybrid metrics having more potential as a strategy setting tool for example, in revealing new business opportunities, or as more of a strategy monitoring tool to measure what you're doing already? Both?
Yeah, I think it's both. I've certainly been talking about it in the monitoring context because I've been talking about it more from the investor perspective, where monitoring and projecting is what matters. But I absolutely think it does create opportunities for companies internally to make better decisions and to find new areas of business, new strategic positions that can create greater profitability and competitive advantage over time. So it is a way of, first of all, connecting the social environmental with the financial in a way that you can't get around. And the problem with a lot of the sustainability reports and metrics now is the connection just isn't clear and it isn't consistent. And so it becomes very confusing to try and build that kind of analysis into your strategy. So if the connection is tight and clear, then there's a reason why you should be thinking about these social and environmental trends and needs in developing your strategy for your particular business. And so I do think it can be helpful as a guiding strategy tool. And as we've tried to say in the paper, if you're one of those companies that's still pursuing social and environmental performance as a matter of reputation and PR and satisfying the critics, this tool isn't going to be very helpful to you because you're not actually gathering the data to make that connection between social and financial performance. And so it's really the companies that have built social and financial performance into their strategy, as Walmart has, as Nestle has, as many of the leading companies in the world have already begun to do, where hybrid metrics are going to make sense and perhaps enable you to communicate the value of what you're doing, the choices you're making, more clearly to your investors, and also be able to see more clearly for yourself internally where the opportunities lie.
And I wonder if the best models of where hybrid metrics are working is with an idea generation as a strategy tool and a monitoring one, come not from the traditional world of ESG, but from companies that have simply been doing it this way business-wise for a long time. You and I have discussed pharmaceutical companies. You know, Eli Lilly has had, I spoke recently with their CFO and chief investment officer, and they're saying their performance over the last 3 years, stock performance has been tremendous. And it, as an outcome of having a long-term focus and protocol of investing in research and development. So for a short period of time, it looked like the way for pharmaceutical companies to get ahead was by cutting R&D and jacking up the prices of pharmaceuticals. And Eli Lilly stuck with its knitting, as it always has, because that's just its own business model. And you know, I think it's an inarguable social good to create a new drug that helps treat cancer patients, or, for example, a COVID vaccine.
Yes, indeed. Yeah, I think that's exactly right. This whole idea of hybrid metrics and frankly of creating shared value is very much tied to longer term thinking, because social and environmental trends and issues and problems and solutions do not happen in a quarter or two. They are longer term trends. But that fact that they're longer term doesn't mean they're in any way less powerful. And so there's an organization, Chief Executives for Corporate Purpose, CECP, that has been doing investor and analyst briefings where corporate CEOs can present their long-term plan, their 3 to 5 year plan, because they don't necessarily have the opportunity to do it in the traditional analyst call. And that's very important. I think we are seeing a growing awareness of the need for longer term thinking on the part of investors and on the part of corporate leaders. And shared value, hybrid metrics, these things very much depend on a company having a longer term perspective. And again, longer term doesn't mean 10 or 20 years. It can mean 2 to 5 years. But thinking, planning strategy in those terms, making your investment decisions, not just looking at the impact next quarter, but looking at the impact a couple of years down the road, I think is a very important dimension of making this work.
Maybe something worth building into a CEO's compensation.
Absolutely. I think, you know, I'm a huge believer that CEO compensation drives a tremendous amount of corporate decision making. And again, this is why I think that if we can reflect in the current stock price the choices that CEOs are making about the near term and longer term social and environmental impacts of their company, we will see changes in behavior that will be very beneficial for the world.
Thank you so much, Mark. I find your work thrilling and fascinating, and most importantly, so does the audience at Institutional Investor. So I'm very, very grateful to be involved. Bobby, back to you.
Well, thank you, Leanna. Let me just thank you as well. It's a pleasure working with you, and you've just been a great partner throughout all of this.
Well, I want to thank both of you, Leanna and Mark. Thank you for that really provocative and also informative conversation. I continue to learn more about hybrid metrics every time we engage in a conversation about it. We also had lots of questions, and we would be happy to share them with both of you, just so you know what our audience is looking for in terms of trying to understand this new tool that will be available to them. So we really see the promise in this tool, but as Mark said, you know, there needs to be more work done, but we hope that the report, as well as the institutional investor article and this session, has inspired some companies to start to experiment with this new way of really explicitly tying the social and environmental impact with standard measures of financial performance. So thank you again so much for this conversation today. And Leanna, thank you for, you know, having moved to Europe and or London and hopping on this webinar so soon after that. We really appreciate it. I also just want to send a quick shout out to the Shared Value Initiative team who works behind the scenes to make these events happen. Sam Wallach, Alicia Dunn, Rima Google. Georgie Eckert, and Imani Hicks, thank you for your help in making today happen. And importantly, thank you to our audience for being with us today and for your interest in hybrid metrics. We hope to see you next month at another Resilience Reimagined session. So thanks again.